The biggest financial disasters in history were not caused by a lack of intelligence. They were caused by decisions. Decisions made by experienced executives. Decisions made by professional investors. Decisions made by people who had already achieved extraordinary success. And that is what makes these mistakes so valuable to study. Because the greatest lessons in finance often do not come from success. They come from understanding why successful people failed. A company can dominate an industry for decades. An investor can build a massive fortune. A business can become a global symbol of success. But one wrong decision can change everything. The difference between a financial empire and a financial collapse is often not a lack of resources. It is the inability to recognize change. Throughout history, the same patterns appear again and again. Companies ignore innovation. Investors follow the crowd. Businesses expand without control. Leaders become overconfident. And risks that were once visible become ignored. The most expensive mistakes in finance are rarely sudden. They usually begin quietly. A warning sign appears. A new competitor enters the market. Consumer behavior starts changing. A new technology begins growing. A financial risk starts increasing. But instead of responding, people convince themselves that the old system will continue forever. This is one of the most dangerous beliefs in business. Because something worked before, it will continue working. But markets do not reward companies for their past achievements. Markets reward companies that understand the future. One of the most common causes of failure among successful companies is what experts call innovation blindness. This happens when organizations become so comfortable with their current success that they underestimate emerging opportunities. The problem is not that these companies lack resources. Many of them have billions of dollars, talented employees, and powerful brands. The problem is that success can create a false sense of security. When a company is leading the market, it becomes easy to believe that competitors cannot challenge it. It becomes easy to believe that new technology is just a temporary trend. It becomes easy to believe that customers will always behave the same way. But history proves the opposite. Industries constantly change. Consumer expectations evolve. Technology creates new possibilities. The companies that survive are not always the largest. They are the companies that adapt the fastest. This same principle applies to investing. Many investors make the mistake of investing based only on what has already happened. They look at past performance and assume the future will look identical. But successful investing is not about copying yesterday. It is about understanding tomorrow. A company that was powerful 10 years ago may not have the same advantage today. A market that produced huge returns in the past may not provide the same. In the future, smart investors understand one important rule. Past performance is information, not a guarantee. Another major financial mistake is ignoring disruption. Every major industry eventually faces disruption. The companies that fail are often not the ones that never saw change coming. They're the ones that saw it and underestimated it. They believe the new competitor is too small. They believe the new technology is not practical. They believe customers will never change their habits. But consumer behavior does not require permission. People adopt better solutions when they provide more value. The companies that survive understand that their greatest competitor may not be another company. It may be a completely different idea. This is why successful businesses constantly study trends, customer behavior, and emerging technology. They understand that protecting the past is not the same as building the future. Another billion-dollar mistake is emotional decision-making. This problem affects both businesses and individual investors. When money is involved, emotions become extremely powerful. Fear, greed, excitement, panic. These emotions can influence decisions more than facts. During periods of market growth, people often become overly confident. They see others making money and assume the opportunity will last forever. They stop analyzing risk. They stop asking difficult questions. They simply follow the crowd. This is known as herd mentality. And throughout financial history, herd mentality has destroyed enormous amounts of wealth. The problem with following the crowd is that the crowd usually feels safest when risk is highest. When everyone believes an investment can only rise, people stop preparing for what happens if they are wrong. Successful investors think differently. They do not ask only, how much money can I make? They also ask, how much can I lose? What assumptions am I making? What happens if the market changes? Because protecting capital is just as important as growing capital. The goal of investing is not to win every decision. The goal is to survive long enough to benefit from the right decisions. Another mistake that destroys businesses is uncontrolled growth. Growth is exciting. Investors like it. Companies celebrate it. Customers notice it. But growth without discipline can become dangerous. A company can increase sales and still become financially unhealthy. A business can expand into new markets and still lose control. More employees, more locations, and more products do not automatically create success. Growth requires systems. It requires strong leadership. It requires financial management. Without those foundations, expansion creates pressure instead of progress. The same lesson applies to personal wealth. Many people believe earning more money automatically solves financial problems. But income alone does not create wealth. A person can receive a higher salary and still struggle financially if spending increases at the same speed. Real wealth comes from managing money intelligently, increasing income, controlling expenses, investing consistently, managing risk. Because financial success is not only about how much money enters your life. It is about how much value you keep and how effectively you use it. The biggest financial mistakes in history teach one powerful lesson. Success does not remove risk. Sometimes success creates new risks. And the people who remain successful are the ones who continue learning, adapting, and questioning their own decisions. Writing. One of the most expensive mistakes in finance is believing that previous success guarantees future success. It does not. A company can have the best products, the largest customer base, and the strongest reputation in the world. But if it stops adapting, those advantages can slowly disappear. The market does not reward companies for what they achieved yesterday. It rewards companies that continue creating value today and preparing for tomorrow. This is why some of the biggest failures in business history were not caused by a lack of opportunity. They were caused by a failure to recognize opportunity. Sometimes the greatest financial mistakes come from saying no at the wrong time. A company sees a new idea, a new technology, a new business model, but because the opportunity does not immediately fit their existing strategy, they ignore it. They believe it is too small, too risky, too different. But many of the world's biggest companies started exactly that way. Small, uncertain, ignored. The lesson is not that every new idea will become successful. Most will not. The lesson is that businesses and investors need the ability to evaluate opportunities objectively instead of rejecting them simply because they look unfamiliar. Innovation requires curiosity, and curiosity is one of the most valuable financial skills. Another major mistake that has destroyed businesses and investments is excessive confidence. Confidence is necessary for success. Entrepreneurs need confidence to build. Investors need confidence to make decisions. But confidence without humility becomes dangerous. When people become too certain that they cannot fail, they stop looking for problems. They ignore criticism. They dismiss warnings. They assume their previous success proves their future decisions will always be correct. This mindset creates blind spots. And blind spots are extremely expensive in finance. The strongest investors and business leaders understand that being successful does not mean they're always right. It means they have built systems that help them recognize when they might be wrong. They analyze data. They challenge assumptions. They listen to different perspectives. They prepare for unexpected outcomes. Because the market does not care about confidence. The market only responds to reality. Another important lesson from billion-dollar failures is the danger of excessive debt and reckless risk. Debt itself is not always bad. Used correctly, leverage can help businesses grow and help investors increase opportunities. But leverage becomes dangerous when people underestimate risk. Borrowing money increases potential rewards, but also increases potential losses. When conditions are favorable, excessive risk can look like genius. But when conditions change, the same decision can become destructive. This is why financial discipline matters. Smart financial decisions are not based only on the best possible outcome. They consider the worst possible outcome. They ask, what happens if things do not go according to plan? What happens if the market changes? What happens if revenue decreases? What happens if expectations are wrong? This way of thinking separates professional decision-making from emotional decision-making. The best investors and companies do not prepare only for success. They prepare for uncertainty. Because uncertainty is the only guarantee in finance. Markets change. Industries evolve. Economic conditions shift. The future cannot be controlled, but risk can be managed. This is the foundation of long-term financial thinking. The goal is not to avoid every mistake. That is impossible. The goal is to avoid mistakes that can permanently damage your financial future. A small mistake can be corrected. A temporary setback can be recovered from. But a decision that destroys your ability to continue can end the entire journey. This principle applies to everyone. Large corporations, professional investors, small business owners, individual investors. The scale may be different, but the patterns are the same. Poor decisions usually come from the same sources. Ignoring change, following emotions, taking unnecessary risks, failing to learn, refusing to adapt. The companies that survive understand something important. The greatest threat is not always competition. Sometimes the greatest threat is becoming comfortable. Comfort creates resistance to change, and resistance to change creates weakness. The financial world rewards those who stay alert, those who keep learning, those who continue improving their decision-making process. Because wealth is not built from one perfect decision. It is built from thousands of intelligent decisions repeated over time. The same applies to personal finance. Building wealth is not about finding a secret formula. It is about developing better habits, investing consistently, understanding risk, avoiding emotional decisions, creating valuable skills, protecting your money, growing your knowledge. Because financial intelligence is one of the strongest assets anyone can develop. Money can be lost, markets can fall, businesses can fail, but knowledge and decision-making skills can help you rebuild. The biggest lesson from history is simple. The giants that collapsed were not always destroyed by their competitors. Many were destroyed by decisions they made themselves. They ignored warnings. They underestimated change. They believed success would continue forever. And eventually, reality caught up. The difference between a financial legend and a financial failure is often one decision. One decision to adapt. One decision to manage risk. One decision to think differently. So the question is not only, what mistakes have other people made? The more important question is, what mistakes are you currently ignoring? Are you spending without a plan? Are you investing without understanding risk? Are you depending on one source of income? Are you refusing to learn a skill because your current situation feels comfortable? Every financial future is built through decisions. And the decisions you make today create the results you experience tomorrow. If you want to build wealth, do not only study success. Study failure. Study what went wrong. Study the warnings people ignored. Because sometimes the greatest financial lessons are hidden inside the biggest mistakes. If you found this video valuable, make sure to like the video, subscribe to the channel, and share it with someone who wants to improve their financial thinking. And comment below.